Hello, everyone, and welcome to Understanding Financial Statements. My name is Linda Griffian, and I'm the Education Programs Coordinator with BusinessLink. Thanks for joining us for our webinar today. We want to acknowledge that in the province of Alberta, we are situated on the traditional territories of Treaties 4, 6, 7, 8, and 10, ancestral homeland of diverse First Nations group, Métis and Indigenous people, whose ancestors have walked this land since time immemorial, and whose histories, languages, and cultures continue to influence our vibrant community. We pay respects to the Indigenous people of this land, past, present, and future, while recognizing their cultural heritage, beliefs, and relationship to the land on which we reside. Thank you for joining us. Busola Abatan is going to present to us today, Understanding Financial Statements. If you would like to ask a question during the webinar, please take a look at the bottom of your screen to the Q&A section and type in your questions into the Q&A box. You're welcome to say hello in chat, but questions seem to fit better in the Q&A box. So we'd love for you to do that. Also, I'm going to place a link in the chat box that is going to have the PDF downloads for today's session. It includes some handouts along with a PDF of the PowerPoint presentation for today's session. This information is being provided to you for general knowledge and should not be taken as professional advice. And it's my pleasure to welcome Busola today. So please welcome and take it away.
Thank you very much, Linda. Good morning, everybody. My name is Busola Abatan, and I am a CPA. It's my pleasure to be here with you today. This presentation will cover the basics of the terms and concepts of financial statements. We have about an hour or so together today, and you should all be able to see the presentation. It's on the screen, and I'm guessing that you want to take notes if possible. Now, this session is designed to be interactive, as Linda has already mentioned, so you can type your questions in the chat. We'll be able to address them at the end, probably. The session is presented by CPA Canada, and CPA stands for Chartered Professional Accountants. Accountants work with numbers to help keep businesses honest and successful in Canada and all over the world. Now, CPA Canada is one of the largest accounting organizations in the world, and it represents over 210,000 CPAs across the country. Canadian CPAs are recognized and respected across the globe for their knowledge and integrity. Some CPAs work in accounting firms, while others work in the industries, such as entertainment, sports, technology, and not-for-profit, and many more organizations. Depending on the type of work they do, CPAs can be responsible for making sure a business's financials add up, for doing their budgets, and for developing business plans and policies to help the business grow. So let's get started. Now, as a business owner, I'd imagine that you want to know how your business is doing and you want to find out how much money you're making every year. But there are other stuff that you want to know, and financial statements there exist to help you with this information. For instance, you might want to know what the financial statements, what the profit and loss statement tells you. What's the purpose of this financial statement? Like, why do you need to have a balance sheet? What does it even mean? Now, another question you might want to know is, where is your cash coming from? Or you may want to know where your cash is going to. A very common question that many business owners ask is, why isn't the cash they have in the bank equal to their profits? So the purpose of this session is just to give you an overview and help you answer a number of these questions. There are three main types of financial statements that an accountant works with. There's the profit and loss statements, which is sometimes called the P&L. There's the income statement. There's the earnings statement. There's the statement of comprehensive income. These are some of the names that the profit and loss statements goes by. Then there's the cash flow statements, which is sometimes called the sources and uses statements, or the statement of changes in financial position. And then finally, there's the balance sheet, which is sometimes called the statements of financial position. So we're going to start by talking about the profit and loss statement. A profit and loss statement is just basically that. It helps you measure what your profit or your losses will be. It compares your revenues with your expenses. And so your revenues minus your expenses would typically equal a profit. But in some cases, it could equal a loss. Now, the profit and loss statements are prepared according to accounting rules. Now, and accounting rules require that revenue be recognized at the time that the activity took place that resulted in the revenue, not necessarily when you receive the cash. The same thing applies for expenses. So for example, let's say you sold goods to a customer and the customer doesn't pay you or isn't required to pay you until 30 days time. Accounting accounting rules require that you recognize that sale when you made the sale, not when you receive the cash or when the money comes in. So for instance, I sell books to someone and I say, okay, in 30 days, the payment is due in 30 days. I'm going to recognize the sale this month when I sell the books and not next month when I get the cash. Another aspect about recognizing revenue is, for instance, if you pay for something, but you don't use it immediately, like for instance, an airline ticket, or you go to the cinema and you buy a ticket for a movie, but you don't use it immediately. Because you haven't used it, that revenue cannot be recognized as having been earned. So until it's used, maybe it's used in 2 months' time or whenever, that's when it's recognized in the book as having been earned. Accounting rules also apply to expenses, as their own expenses are only recognized in the books when they have been incurred. So for instance, if you pay for something, you prepay for something like your rent, the rent for your office or the building where your business is, but you haven't used it up. You pay for rent for May, for example, and you're still in April. You paid that rent in April. You're not going to recognize that rent until May when you're actually using up the rent. Another example is if you pay for something after the service, you've enjoyed the service, but you don't pay for it until later, like in another month's time. Maybe you have a caterer cater to your office staff, and you don't pay for it until a month after. When you've enjoyed the benefit of the catering, that's when you recognize the expense. So because of these accounting rules, it often results in a difference between the profits and the cash, but we'll get to that later. But when these accounting rules are being used, a business is said to be using accrual accounting. And this is one of the terms that's defined in one of the handouts that's been provided by Linda. And accrual accounting means revenues and expenses are recognized in the period to which they relate, and not when the cash is received or paid. Okay, I can see a question here that says any free software we can download. We'll get to that at the end.
I think my big question about the free software is, why do you want free?
Yeah, that's
so we can certainly shelve that one till you're ready to answer that one in a bit.
Okay. So moving on, we're going to focus on the income statement or the P&L statement now. And typically the P&L statement has 3 categories. The first category is the sales activities category, which basically reports the revenues and expenses associated with selling to the customers. And then the second category is the operating activities category, which focuses on the expenses that are related to operating the business. And then the third category is the non-operating activities category, which deals with things that are not, regular, that are not common, like your interest expense, income tax, and one-time unique income and expenses, stuff like that. We're going to look at an example of the sales activities part of an income statement. And generally, the sales activities the first item on your sales activities, part of the P&L statement would be the revenue, which is the money that you get from what you sell or from the service that you provide. And then the next line is called the cost of goods sold, which is what it costs you to make that sale. For services like maybe a plumber or somebody who's a hairdresser, it will be what it costs you to provide that service. And the difference between the revenue and the cost of goods sold or the cost of services is called the gross profit. Now we have an example there, a sample sale activity where the revenue was 100,000, and what it cost to make that sale or to make that revenue was 36,000. And when we subtract the 36,000 from the 100,000, we have the gross profit of 64,000. Now, gross profit, sometimes some people call it gross margin, is the beginning of how much a business is able to cover its a business's revenue is able to cover its cost of goods sold. And for any business that wants to remain profitable and in business, it's important that that number be positive and not negative. And then we move to this next section of the P&L statement, which is the operating activities section. So in this section, you have basically the expenses that are involved in making the sale or keeping the business going, I should say. For example, your selling expenses, your research and development, general and admin, and your depreciation expense. So some examples of things that would be there, like you could type in the chat. Let's say we have an example of a business, a bakery, for example, like somebody who runs a Cobb's bakery. Can you type in the chat what you think would be some examples of the cost of goods sold? If you're able to, you can type some of those in there, and so that you have a better idea. But right on top of my head, I think the cost of flour, for example, would be an example of the cost of goods sold for somebody who's running a bakery. But you can type more examples in the chat as you go along.
We have the cost of butter and flour.
Yeah, thank you. That's awesome. Yes.
Ovens.
Okay, yeah. But that's not the cost of goods sold. We'll get that. Ovens, because ovens is something that you use you use it for a long time. So I wouldn't say ovens is, yeah. Power and electricity, I would say those are operating activities because they don't directly tie into the cost of goods sold. Wages, yeah, for the baker, yes. So in the items I've seen in the chat, I've seen some items that belong to cost of goods sold and then some items that also belong to operating activities. An example of operating activities, someone has said power and electricity. Yeah, that's correct. And then wages, for instance, for the person who's making the sale, the person who sits at the front desk, who sells the items that you're making. There's also maybe advertising. Perhaps you might have somebody who's running your maybe Instagram page or something. You know, the fees that you pay to that person for keeping your page, the page for the bakery running. That's also an example of an operating activity, an operating expense. So for our previous example, where we had the revenues of 100,000, and then we also had the cost of goods sold of 36,000, and we had a gross profit or a gross margin of 64,000. If we have the selling expenses of 15,000, for example, and then research and development of 4,000, and general and admin of 2,000 and depreciation of 5,000. So we have a total operating expenses of 44,000. At the end of the day, when we take the 44,000 away from the 64,000, we have operating profits of 20,000. And again, I mentioned that every business wants those numbers to be positive, the results of all these subtractions to be positives, so that you can stay in business and continue to, generate revenues and keep your business, sustain your business. So gross profit minus your operating expenses equals to the operating profits. Then we come to the non-operating activities. Now, the non-operating activities are things that you typically wouldn't expect to happen regularly. So for our bakery, for instance, they might have a line of credit with the bank where they're paying interest every month. So that's an example of a non-operating activity, an item that will fall into that category. There's income taxes. And then, for instance, they may have things like some of their inventory might be obsolete, or they might even be throwing away some of their unsold goods, like the bread. I know Cobb's, you have to get rid of the bread like after a day and all of that. You might have to throw that away. So those kind of inventory would come into the non-operating activity section of your income statements. Yeah, I see somebody mentioned packaging. Yeah, packaging is definitely cost of goods sold. I agree with that, yes. So again, going back to our example that we had, after we had operating profits of 20,000, let's say for our line of credit with the bank, we're paying $4,000 a year. And then we also had to pay $6,000 income taxes. And at the end of the day, our net profit is $10,000. And this $10,000 tells us it's what is typically called the bottom line or net income or net profits. And it tells us how we did, how much we made that year, the bottom line. And again, for any business that wants to stay profitable, you always want that to be positive. So the next.
Oh, here we go. Can you give an example of depreciation?
Yes, we're going to get to that in a few minutes. Yes.
And why is the principal from a loan not shown, but the interest is?
Okay, yeah. So two very good questions because you've jumped ahead of me here.
Okay.
We're going to get to those next.
Okay, so everybody hang tight. We're getting to both of these questions.
All right, so now I'm showing you what the balance sheet is. And the balance sheet shows your assets and your liabilities side by side. Your assets are the things that you own, like your cash, the money that's owed to you by your customers, which is accounts receivable, the inventory, and your fixed assets, like your plants, your property, and your equipment. So, for instance, when I asked about the items that would be in cost of goods sold for a bakery, somebody said ovens. Yeah, ovens are owned by the bakery, but they're not put in the income statement because you're using them every day. You don't use them up until maybe after 5 years. So you would keep them in your balance sheet here. This is where they will be. And they will be part of what you include in your plants, property, plants, and in here, in this line. They'll be part of what's included in your property, plant, and equipment. They'll be part of your equipment. And then on the other side, as I had mentioned, are the liabilities, which is the monies that's owed to lenders and monies that's owed to vendors. So this is where you would have your loans and things like that. Also in your balance sheet, you also have your owner's equity, which is the part of the business that is the money that the owner puts into the business. It's the money that the owners invest in the business. And as well as profits that they haven't taken out, they haven't paid themselves. The assets of the business must always be equal to the liabilities and the owner's equity because the assets are financed by the liabilities and the owner's equity. So for instance, whatever plants, whatever property, whatever investments you make in the business, inventory you buy is paid for either by a loan or by the money you put in yourself. So they always have to balance. And the balance sheet typically gives us a picture of the business at a point in time. So for instance, it doesn't tell us, it tells us that while the profit and loss tells us how the business has done over a period of time, like for a year or for a month, the balance sheet tells us this is what the business has done at this point in time. Now, under accounting rules, assets and liabilities on the balance sheet are carried at historical value. This means that the assets are carried at the cost of acquisition less depreciation. So somebody had asked about depreciation before, and depreciation is how you expense the use of an asset over time. So while it's correct from an accounting perspective to include the cost less depreciation on the balance sheet, using the historical value means that the value of assets and liabilities in your balance sheet might be different from the actual market value. For instance, the market value of your oven might be much more than what you have in the balance sheet because it's an antique oven that somebody would like to buy, or it might be less because it's used up and it's old and you need to get a new one. So it's often very different. But as the financial statements are for a specific purpose and they are prepared in accordance with accounting rules, you always have to use what the accounting rules specify that they are. So there are also other things that are included in your balance sheet, like intangible assets, which are not physical assets. Examples of intangible assets would include things like patents, trademarks, and brand names. Now, only some intangible assets can be recorded on the financial statements, typically those that are acquired. The ones that you generate by yourself, like your brand recognition, is not included on the financial record, on your financial records. Now, someone had asked about depreciation. I'm just going to look back at what the question says. So, so someone had asked if we could give an example of what depreciation is. So depreciation is a non-cash operating expense that allows a business to provide for the wear and tear of its equipment. So in the example of the oven, for instance, let's say we buy the oven for $10,000 and we know that we're going to use it for 5 years. Because we're going to use it for 5 years, we're not just going to put all the cost of that oven in our P&L or income statements. We're going to have spread the cost of the oven over the 5 years that we're going to use it for. So since we bought it for 10,000, we're going to divide that 10,000 by 5 years to arrive at 2,000, which would be what we would include in our profit and loss statement every year for 5 years. So that's an example of depreciation. I think somebody had asked that. Now, each year, the oven is depreciated by the $2,000 value until we finished depreciating it. And then in the balance sheets, what would be included there will be the cost of the oven minus the amount that's depreciated. So for instance, the first year we do 2,000, the second year it's total of 4,000 and so on and so forth. And the value keeps going down until it gets to zero. So in the profit and loss statement, we put the annual cost of 2,000, and in the balance sheet, we put the total cost of the asset less the total depreciation to date. So I have an example here of a balance sheet. Now, the asset side of the balance sheet specifically, and it's split into two. The top part, which is the current assets, and the bottom part, which is fixed assets. The top part of current assets refers to assets that are going to be converted to cash within a year, or they're already cash, while the bottom part are assets that are typically not easily converted into cash. So for examples of things that will be in the top part are as shown in the slide, like things like your cash, like inventory that we would sell within a year, your accounts receivable, that's the monies that your customers will pay you within a year. And then the things that are at the bottom, for example, like your property, plant, and equipment, minus the depreciation, which we've spoken about just now. So in our example, on the right side of the screen, we can see an example of a balance sheet. In my example, the business has $25,000 of cash, $20,000 of inventory, and $10,000 of accounts receivable, monies that they expect to receive from their customers. And the total current assets is $55,000. And within, they expect that all of this would come into the business as cash, at least these two anyway, within the next 12 months. And then there's the fixed assets, which is their plant, property, and equipment. In our example, let's say it was our oven in our Cobb's bakery business, what, $50,000. And we have used it maybe for just 1 year. So we're depreciating it by $5,000. And at the end of the day, it's only worth $45,000 because you've used up like $5,000 worth of that oven. And at the end of the day, we add the total assets, the total current assets, and the fixed assets, and we have total assets of $100,000. And then the other side, I had mentioned previously that there are two sides of a balance sheet. The asset side, which we've just spoken about, and now the liability side, it's the opposite side, what is owed to the business. The first side talks about what the business owns. Now this talks about what the business owes. And like the asset side, they're the current liabilities, and then they're the long-term liabilities. Now the current liabilities are those liabilities that need to be paid up within a year, while the long-term ones are due like further into the future. So examples of current liabilities include accounts payable, that's monies that the business owes its suppliers or vendors, as well as loans that must be paid within the year, like maybe you have a credit card balance. And then the long-term liabilities, which might be loans that will be paid further into the future. So like you might have a line of credit or something with the bank that you don't have to pay up all of it this year, or even a mortgage, for example. That could be a long-term liability. This example says bonds and loans payable. So on the right side of the screen, we have a business that has accounts payable, that's amounts that's due to its vendors of $30,000, and you have a loan, a bank loan of $5,000, which will be credit card and must be paid within the next year. These are called current liabilities. And then there is the long-term liabilities, which is a loan that must be paid into the future, and it's $25,000. So the two of them added together give $60,000 liabilities. If you remember our previous slide, we had $100,000 of assets. So this $100,000 of assets is financed, $60,000 of it is financed by these activities. And then the other part of the liability side is what the owners of the business have contributed to the business. So for example, people might have put money in the business. They might have investors coming from outside who put money into the business. And the total that they have put in the business is what goes into this part. So the owner's equity, that's this part. It's sometimes called the shareholder's equity, the proprietor's capital, or a partner's capital. And it's not the value of the business. It's just what they've put in. Now, some owners, in addition to having their equity in the business, they also leave some of their monies in the business. They don't take out all the profit that the business makes. And so these are called retained earnings. And they are created through an accounting entry. And retained earnings, they are accumulated profits of the business since its inception that have not been paid out to the owners as dividend. And the concept is pretty simple. So if a business makes profits and the profit is either returned to the owners in form of dividends or is left with the business and used up by the business, those are two options that a business has. You can either give them dividends or you keep it in the business. Now, if it's left in the business, if you don't take it out as dividends, it is categorized as retained earnings. So you can think of retained earnings as like your money that you've reinvested in the business instead of paying yourself that money. So in our example, the owners of this business initially invested $30,000 cash. And then as the business has been making, money, getting profitable, they've been keeping, all the profits up to $10,000 in the business. And so in total, the owners have $40,000 equity in the business. And so if we look at our full balance sheet, this is what it looks like. We have the two sides balance. The asset side is equal to the liability side. You can see, as we mentioned, we have $55,000 of current assets, $45,000 worth of fixed assets, which is $100,000. And these are all financed or taken care of by the stuff on the liability side, which include, the liabilities and the owner's equity of $40,000. Again, $100,000. Very important to note that the two sides must be balanced, they must be equal. The assets must equal to the liabilities and the owner's equity.
At the end of the day, Busola, when a business owner looks at their balance sheet, what are they trying to identify on their balance sheet that would be of concern perhaps for them or difficulty for them? Or is there something? My understanding of a balance sheet is it's a snapshot of your company at a point in time. So it's like taking a picture of your company. What my balance sheet looks like today might change tomorrow. Mm-hmm. So when I'm looking at this snapshot of my company today, what would be a key element I am looking for? Is there anything that I need to understand today to identify for my business to make strategic changes?
Yeah, so for instance, you want to make sure that your owner's equity is positive. Like this is 40,000. It could happen that you've been making so many losses and those losses have taken out your owner's equity. So this could be negative. Another thing that you want to make sure you're looking out for are your current assets, that you have a good base. You have current assets that are a significant high figure. I'll give an example now. If you look at this balance sheet, there's the current asset side, there's the current liability side. You can see that the current assets are more than the current liabilities. And so you want to make sure that this is the way it stays. You don't want to have your current liabilities exceeding your current assets, because it means that you can't pay off your current liabilities. So imagine if this was 55 and this was 35, that means you don't have enough stuff to pay off, the items on this side, which is what you owe. And that is very important. Ideally, they always say that you should have twice 1.5 to 2 times as much as current assets as you have liabilities.
Okay, so I'm going to stop you there. So everyone understands when you're looking at your balance sheet, A healthy balance sheet, what you're looking for is ideally, and for most business owners, this is probably not going to be the case, so don't panic. Ideally, your assets are valued at 1.5 times what your liabilities are.
Yeah.
Another thing I look for also in the balance sheet is how much of my assets are tied up in things like inventory and buildings and equipment, because those are not liquid. So if I run into trouble and I start running out of cash, in this scenario, I have $25,000 of cash in the bank, but I'm going to have to figure out a way to liquidate my inventory a little quickly if I need more cash, or to liquidate some of my plant property and equipment. So those are the kinds of things you can kind of see in your balance sheet on a day-to-day basis as well. Another quick one that maybe we should tackle now is, do you have an easy way to remember depreciation versus amortization? So what are those two things?
Yeah, those two terms are often used interchangeably. So some people will call it depreciation, some people will call it amortization. But explaining it is going deeper into accounting. Amortization has to do with your intangible assets. Like maybe you have your brand, you have a patent, for example, which you paid for, and you have to evaluate to see if it's still what you paid for it. If it's not what the same, maybe if it's devalued because maybe somebody else has it, the same kind of patent or whatever, you'd have to write it down, and that's often known as amortization. While depreciation has to do with your fixed assets, like writing it down for the wear and tear that you're using it. For the wear and tear that you're using the asset for every year. That's just basically the difference. But most times, many people tend to use them, interchangeably, and it's really acceptable.
Great. And the last one of the other ones I'd like to get to is, what is wrong with doing strictly cash accounting? The idea of having revenue before one is paid seems only to benefit governments who can charge tax on money one does not have. So what is wrong with doing strictly cash accounting? Or is there anything wrong with it?
Well, there's actually nothing wrong. The number of businesses do cash accounting. However, it doesn't really give you a true picture of how your business is doing. Because if you've sold something, you should recognize that you've sold it, even if the money hasn't come in, right? And if you've if you've enjoyed the service but haven't paid for it, I mean, you should recognize the fact that you're owing that person that money. So perhaps I would say accrual accounting gives an accurate picture in a sense. Many businesses also do cash accounting, and there's nothing wrong with that. But accountants kind of like to keep things true to a picture. And another reason why maybe accrual accounting is beneficial is because it's what accountants typically do. It makes it easy for you to compare your financial statements with that of another business, because another business might be doing accrual accounting and yours is in cash, and you can't really compare the two because you're not comparing apples to apples. I hope that answers the question.
And last but not least, a few people, and initially I thought maybe it was their systems, but a few people are having some trouble hearing you. Are you able to turn up your microphone volume? I'm not sure if we can or not, or if you've got it on the loudest setting internally on your.
Okay.
I'm able to hear you, and many people are. So I think there's just a couple people maybe who are on mobile phones, and a few of those, maybe we'll just get those.
I think I'm on the loudest one.
Yeah, I think so too. And just for everyone's benefit, we have the PDF in the handouts as well as the presentation. And I believe you can turn on closed captioning. Maybe let's see if we can get that on if people captions. Let's see. I think we can put the closed captioning on as well if that's a issue for you as well. Yes, it is. Here we go. We've got closed captioning on for everyone to see if you're having trouble hearing. And I have another one on the balance sheet. Is the only way to see the $60,000 finance in the liability section of the balance sheet? Okay, so this is about financing. Where do you see your financing on the balance sheet?
Yeah, that's the $60,000. Yeah, but it's the $60,000 is actually the accounts receivable, your bank loan, and your bank loan. So the bank loan is split into two. The first part, the part at the top is the one that's due within the year, and then the part at the bottom is the one that's due after a year further out. So your total financing in this case would be the 25,000 plus the 5,000, which is 30,000.
And we have two questions from Kathy, which we could probably get to. First one is, how do you analyze your profit and loss statement?
I'll go back to the profit and loss statement.
Okay.
So when you say analyze, like you want to know how you're doing. So you could calculate some ratios, some financial statement ratios. So one of those ratios that's often, useful for somebody who wants to analyze is the gross margin, which is the gross profit divided by the revenue. And in this case, if you did that, would have like 64%. And then we could also calculate the operating profit margin, which is this again divided by revenue, and then of course the net margin, which is this divided by revenue. That's one way, using ratios to see how you're doing, if you're doing well, and then you can compare it year on year. It makes it easier for you to compare year on year.
Good. And what I'm going to do is I have an article from the BDC, if anyone's following in chat. The Business Development Bank of Canada has whole sections on learning about finance and financials, and I'm entering in the article on ratios. So that's one way they can use the profit loss statement, is understanding those ratios. And for anyone who's interested in digging in deeper, I've put in the BDC link to what ratios are and how to use them. So that's in the chat.
Awesome. Thank you very much, Linda. So now, moving on, we'll talk about the cash flow statement. So somebody had asked why we don't just do cash. And I explained about the fact that you want to be comparable with other businesses and you just want to follow the accounting rules so that your business actually represents what is truly happening. So a cash flow statement. Obviously, if a business is running, you want to have cash. But really, if you think about it, which is more important? Some people say cash and some people say profits. So I'm going to put this question out there and you can type your response in the chat. What do you think is more important? Do you think cash is more important, or do you think the profits of a business that it's making are more important? Please type your answers, whatever you think it is, in the chat. Now, cash flow is very important to a business. A business requires cash to pay for its expenses. Now, without sufficient cash flow, of course, we know that a business is going to fail. So the role of the cash flow statement is to show a business where its cash comes from and where it goes to. The cash flow statements show that the cash received during the period, as well as the cash paid out during the period. And it also shows the cash at the beginning of the period, as well as the cash at the end of the period. So looking at this structure here, you can see the cash at the beginning of the period, and then where the cash goes, which is the cash received and paid, and then the cash at the end of the period. Now, some people call the cash flow statement of uses, sources, some people call it the sources and uses statements. So the names, again, like I mentioned at the beginning, can be different, but basically what they're talking about is the cash flow statement. Understanding the cash flow. A business can obtain cash from multiple sources. There are many ways that a business can generate cash. So these include the operation of the business, like the goods that the business is selling. It could also get cash from lenders and investors, as well as from selling their assets. However, only operating cash flow is sustainable. And operating cash flow is the cash that comes from the business's main operations, from the sale of its products and services. There are other types of cash flow. There's the financing and asset activity cash flow, as seen on the slide here. And this is money that the business obtains from lenders and investors. This is not sustainable. It's not the reason why you have your business, to keep on borrowing. Other activities that go into this part of the cash flow is repayment of loans to investors and purchases and sale of assets. So as I said earlier, a profitable business generates cash from its operations, which is what it's meant to do. And typically, again, financing and asset activity don't happen often. They're not recurring. So we wouldn't expect a business to depend on that as its source of generating cash. So I have here an example of a cash flow statement. And in this example, the business receives cash from both its operations and its financing activity. Now, operating activity cash flow is recurring cash flow that keeps the business alive. And these includes its cash sales, credit and debit card sales, as well as payments from its customers. Financing and asset activity cash flow are infrequent. They don't happen often, and they can generate cash for the business. For instance, a business might take out a loan to purchase a piece of equipment, and the loan proceeds would show as a financing activity. In this case, it's $32,000. Likewise, a business might sell some assets, such as maybe they have a dump truck, maybe they have some old furniture or an old oven, and they receive cash as well. In this case, it's zero because they didn't sell anything. Again, the owners of the business might put money into the business. They don't do that every day, but they might do that. And when they do that, this is an example. In this case, it's $13,000. So from our example that's shown on this slide, 90,000 of the cash that the business has comes from operating activity, which is what the business is meant to do. And then an additional 45,000 comes from loans and just the owner's equity. So in total, the business received $135,000 worth of cash.
Things as we're going through this is a lot of people will say, well, my business is profitable. A lot of profitable businesses don't survive. And one of the reasons they don't survive is because they have no cash flow. So when we talk to entrepreneurs at BusinessLink about, healthy businesses and that sort of thing, we often say you can have a profitable business, but if you don't have cash flow, you could be out of business very quickly. Is that true when we say that to entrepreneurs?
Yes, that is true. And one of the reasons why that could be happening is because you're selling and maybe you're not following up on your collections. So if you're not following up on your collections, then you wouldn't have money in the bank. Another reason why that could happen is perhaps you have some loans that, although you're generating revenue and making money, you're having to pay off those loans. And as somebody had asked before, somebody had asked about principal, why the principal doesn't come on the P&L, the profit and loss statement. It's because you don't put the loan on the profit and loss statement. It goes in your balance sheet. And so because you're paying out the cash, your profit and loss doesn't show that you are paying out that cash. It's in your balance sheet and it's in your cash flow statement. So if you look at your cash flow statement and you have a negative cash balance, but you have profits, you'll be paying out loans, which, you wouldn't have money to keep the business afloat. So going on to talk about what's on this slide. So when a business is operating, it needs to pay its suppliers. That's the question that Linda had just asked. It needs to pay its workers and other operating expenses. In our example, this business pays out $75,000 for these expenses. Also, we can see that the business has some financing and asset activity cash flow. So in this case, $50,000 of asset purchase as well as $2,000 of loan payments. That's what's in the financing activity part of it. Now, on the previous slide, we showed that the business was obtaining a $32,000 loan from the bank, as well as $13,000 from the owners. They had put that in. Now, on this slide, we see that they spent this to purchase additional assets. Maybe they got a new equipment. So I'm going to go to the next slide, which will show two types of cash flow statements. The one on the right shows that the business starts out with a beginning cash of $17,000. And they go through their business, from their operating activities, they have $90,000 that they generate from their operating activities. But then they had taken a loan from the bank and all of that, so they had $45,000 that they got from that source. So the total cash received by that business was $135,000. However, to run the business, they had to, pay out cash, for their inventory, for their purchases, for interest on the bank loans, for their income taxes. And they also had to repay the loans that they had made. Again, back to that question about loan repayment, this is where it comes. So for the loans they had taken out, they had to purchase, assets that would keep the business going. And at the end of the day, they paid out $127,000, but they had made $135,000. So at the end of the day, after taking the cash they paid out from the amounts that we received, they had $25,000 at the end of the day. So this is a plus, they're doing well. Now the second business, they start with zero. Maybe it's new, maybe they didn't have any cash, or they've paid out all the cash they had the year before. And they go through, they have sales and all that. They generate $60,000 worth of revenue from cash from their business, like operating activities. But then they had a loan, and they had they took a loan, and then there was loan as equity. And so at the end of the day, they had 120 total cash coming. However, they paid so much to their suppliers, to their workers, and operating expenses, $47,000. And then they also had loan payments, and they went ahead and bought a major asset, $150,000. And so they paid out $201,000. And by the time you take out what they paid out from what they owe, from what they made, you're in a negative position of $81,000. Obviously, every business wants to be here because you have cash here to keep the business afloat. You don't want to be here. Even if you are profitable, like if you look at this business now, if they're making profit from their operating activities, like the example that Linda mentioned, they have sales of $60,000 and they paid out $47,000. So if you take the operating activities, you can see that they probably have a profit of $13,000. But then because they had so many other things going on, they end up with a negative cash of $81,000. And sincerely, a business like this could collapse, even though they're making, profits.
We have a few questions here on this. One is, where did business number 2 get the extra $81,000?
Oh no, this is a loss there. They didn't get this. They are losing this. They are owing this.
They're owing the $81,000, Mona?
Yeah.
Okay. Just for everyone's benefit, if you're a new business owner and this is all like new, or this is a little in depth, please do not panic. When I first started my first businesses in my early 20s in the 90s, when we didn't have a lot of accounting software, I spent a number of years really digging in and learning from my accountant. So, one of the things you want to build into your pricing model in your business is you want to build in the ability in your business to have, I would say, this as your first advisor. You're an accountant as your first advisor. And you really want to build that in, because this is the person who you can lean on, who has all the expertise, takes all the professional development courses, takes all the schooling, knows all the tax regulations. And rather than using them to just do your year-end accounting, you leverage this person once a month or once every 3 months to be working on these things with you. That's your role as the owner of your business, is to have that advisor in your back pocket. You're paying them for their services. It's your job to get to the right questions with them. So in this session, you're just not going to be able to drill into all the deep down stuff on an hour here. This is something where we're now learning the language of finance, learning the 3 key statements that we're going to have to sort of look at and learn to understand. And that's probably for most of us not happening today, because it's a lot. It's just a lot to take in. So don't panic if you're not taking in every bit of the numbers or taking it all in, because this is something you're working towards. This is sort of a learning section here today of what are the basics, what's the language, and what are some of the key little things you're looking for at this stage, so that you can work with a professional to get some of the more in-depth answers that become very specific to your business. So that's key takeaway one, is this is the type of advisor you need in your business. Takeaway two is you need to create your business model so that it builds in the cost of having this advisor in your business. And then three, take the time in the next year or two as you're building and learning, and maybe you don't have the money right now for the advisor, to learn the language of finance so that you can speak and leverage that advisor effectively once you have the ability to pay for them. So that would be three takeaways there. For those of you who are asking about the BDC, because I'm leaving a lot of resources from the BDC in the website, for a number of years, I was a small business advisor with them. The BDC is the Business Development Bank of Canada. It is a crown corporation. It's funded by you, the taxpayer. It is a development bank. Most G7 countries have them, except for the US. We have what we call development banks. That bank is owned by the taxpayers. That bank is your bank as an entrepreneur. It only works with entrepreneurs. It doesn't work with other kinds of people, just entrepreneurs. It usually works with entrepreneurs who have 1 or 2 years in business. You have to show a little bit of history. But if you go to their website and you access their tools and their articles and the materials, all of that is free, along with the financial courses they have freely available to you because you, the taxpayer, are paying them for that. So please take a look at that bank as well. And now I'm going to sort of pass it back to you, Busola. Sorry to interrupt, but we're getting a lot of sort of granular questions, and I wanted to tackle that issue a little bit for that.
Thank you very much, Linda. I appreciate that. I assume that, well, because I'm not looking in the chat, I might not be able to see that. So thanks a lot. So I hope that I'm happy that Linda has shared that, and I agree with her 100%. So now we saw in the previous slides, we talked about the profit of a business as well as the cash. Why are they different? Why would they be different? It's just like how Linda had asked a question before. That's how can a business have profits and then they don't have any cash? Or they have negative cash in the bank. And there are several reasons why that happens and why cash and profits are different. Like, for instance, revenue is typically recorded when a good is transferred or a service has been performed, just like I talked about accrual accounting earlier. It doesn't matter when you get the cash, it's when the goods are received or when you perform the service. So if you don't follow up with your customers to make sure they pay you, like you're selling stuff on credit and you don't follow up with them to make sure they pay you. And even if you're following up, if some of them are not paying and you don't have a collections department chasing them for your money back, you have a difference. Then cash inflows often occur when payments are received, and expenses are recorded when goods have been received and services have been used. So irrespective of when cash has been exchanged. Now, cash outflows occur when the bills are paid. But because you're recording this at the time that the events occur, timing, that's pretty much it, why cash and profits can be different. And then, I already mentioned it, that a second key difference is that expenses are recorded when the service has been used or when something has been purchased. Yet the cash flow occurs when the bill is paid. Any business that does not pay the same day that the service or the goods are received will have a difference between the expenses and the cash flows. The same thing happens with revenues. So not all cash flow activity is reflected in the profit and loss statement. Again, going back to the question about the principal on the loan, that doesn't come into the profit and loss statement. Another example is when you purchase an asset, you don't put that in the profit and loss statement. If you buy that oven for that bakery, for example, you're not going to record that in the profit and loss statement or in the funds received from the owners or from lenders. These only affect the balance sheet and the cash flow statement, but they don't affect the profit and loss statement. As a result, you will have a difference between your cash that you have and the profits. Also, financing and asset activity very often have to do with the purchase of assets used by the business, which are treated as long-term activities rather than those that affect the current profits and losses. So
This is a good point where we have a question from Jen that might fit here. Wouldn't the major assets be recorded differently? Is this assuming they paid cash and didn't get a loan of some type?
Sorry, I didn't hear that. Can you read that again?
Okay. So we're talking about cash and assets and one of the questions we have about that is, wouldn't the major assets be recorded differently? Is this assuming they paid cash and didn't get a loan of some type? So are assets and cash recorded differently?
Assets, cash is an asset, right? So
okay.
if you mean, I think maybe you're trying to say, are your long-term, your fixed assets and cash recorded differently? Yes.
Okay.
In the sense that your cash is a current asset and your fixed assets are long-term assets, but they're
okay. Okay, that's great. Thank you.
Yeah, so financing activities that affect the balance sheet and not the profit and loss. I already mentioned that the owner's equity, that affects cash, loans, proceeds and payments of loans. When you take the loan and when you're paying back the loan, they affect cash, they don't affect your profits. Assets that you purchase or you sell, they affect your cash and your fixed assets, but they don't affect your profits. So like investments, loans, and all these activities, they are not recorded as revenue because they're not revenue. It's the monies that you make from using these things that come as revenue and expenses. In of themselves, they're not revenue and expenses. So these are some of the reasons why your cash and your profits are different. And with that, I've come to the end of my presentation. I believe Linda has already shared some of the resources in the chat box, which you can refer to. Some of them are the glossary of terms to explain some of the technical terms I've described today. There is an implementation checklist, which you can have to implement some of these things in your business, and then as well some resources from the BDC. So if we have any more questions, I can take those now. I think maybe they're in the Q&A.
Here we go. What are some early signs of cash flow problems?
Wow. Well, the easiest one is the fact that you can't pay your creditors and your vendors, and that you're not able to pay your bank. That's right off the bat, the first one. Once you notice that you don't have enough cash in your business, that you can't pay them. But then you can also, when you prepare your cash flow statement, you know, if you go to, if you're operating cash, I'll go back to that slide so you can see which one I'm referring to now. So if you have here that, is there one that has? Yeah. So if here you have that your cash received is less than your cash paid, like in this second situation, they had less cash receipts than the cash that they paid out, then for sure that's the fact that you have cash flow problems. So that's why it's important to keep a cash flow statement like handy or in front of you. You should have one pretty much every month. But as soon as you start having problems paying your bills and your suppliers, then you know that you have a cash flow problem.
And a lot of your accounting software will generate these statements for you once you have it set up properly. So once you set up your accounting software, you're able to pull these statements on a daily basis directly out of your software. It's another great reason to, you know, I know free is nice, but free doesn't always give you the dashboarding that you need to see what's going on in your business. We have a question, what is a good accounting software? I did put a link to a BDC article in the chat for good accounting software. They have some recommendations for it. Busola, do you have any recommendations for a good accounting software?
Well, I would agree with Linda's comment about you know, recommendations, but I know people use QuickBooks. There's QuickBooks, there's Xero. I'm not
FreshBooks is another. We do have, I also put a link in the chat for everyone. We have downloadable guides from Business Link. I did put that link in there as well. And it's a whole suite of financial guides, including how to choose an accountant and some samples of software as well. So that'll be good for everyone to take a peek at. We have a couple of others. If I want to sell my small business, how can I estimate approximately its value? Ooh,
Wow.
that is, uh, that's one that I think varies company to company, doesn't it? It really
Yeah,
varies on what you're doing.
yeah, I agree.
So my short answer to that is you sit down with your accountant and you go through all of these statements together and check on what the last historical years have done for you, the 2 or 3 historical years, and talk about things like retained earnings. Would it be fair, Busola, to say that retained earnings play a key role in value of your company? A lot of people don't realize that.
Yes.
If you have a company and all you're doing all the time is pulling money out of it for yourself and not leaving anything in, it devalues your company.
Yeah, that's very correct. I agree. And you find that many small businesses do that because they kind of intermingle their funds. So they just pour out money all the time. And I wouldn't recommend that.
Yeah. We have another one. In growing your business, is it better to borrow money from the bank or use savings? That'll be interesting. I'm interested in hearing your answer to that.
Yeah, I think it just depends on your capacity to take risk. Personally, I would rather use my savings funds. If you have other things that you'd rather use your savings for, and then you want to take a loan from the bank and you don't mind paying the interest, because there are 2 ways to look at it, right? When you use your savings, you're losing interest. And then when you go to the bank, you're paying interest. So you have to see what risk you want to, you'll have the capacity to take one. And then you also have to consider, how far you want to take your business. Do you have enough money saved that would help you grow the business, or will the bank be able to give you more? I think it's really a question of personal preference, how much money you have saved and how much you can get from the bank.
And just to sort of put a few thoughts out there for people, a lot of people will purchase assets for their business with their own money and cash on hand. And these are assets that depreciate. So equipment and expensive things that depreciate the second you start to use it or drive it out of the bay, so to speak. Some of those, check with your accountant and your bankers. Some of those things, if they're depreciating assets and you want to keep cash on hand, it might be better in those circumstances to take out that lease or to take out that loan and keep cash in the bank instead of paying full out cash on the purchase price of cash on hand, when you could keep it for other things that grow your business, like marketing or sales or employees. So those are things to weigh when you're thinking about that. And Hannah, I know you have a question here about car loans. And what about car loan used for business and interest apply? Where can it be recorded? So car loans are always a big question.
Yeah, so car loans, I guess you can look at that from 2 perspectives. Like if it's a lease, so a lease, you can of course record in the profit and loss statement. But if it's a loan that you took out, like you bought a car and every month a leased car, for example, is not yours. So it wouldn't appear on your balance sheet. And so it's an expense. But if it's a loan for a car that you bought, that it's yours, that it's in your name and all that, then you would have to look at the 2 sides of the balance sheet. The asset side, which would be the car, and then the loan, which you use to finance it, will be on the liability side. So those 2 would both be in your balance sheet. And then the interest that you're paying on that loan is what goes into the income statements. I hope that answers the question.
And sometimes there's just so much to try and pack into an hour. So thank you, Busola, for taking some of these questions, and everyone for staying an extra minute. We're going to go 1 more minute. One last question. How often do we need to review our balance sheet, financial statement, and cash flow? Monthly or quarterly?
As often as you want. You can do it daily, you can do it monthly or quarterly, as often as you feel you need to. Because as Linda has mentioned, the software generates this every day. So, it's good to keep an eye on it. I would recommend monthly at the very least. You could do it more often, but at the very least, I would suggest monthly.
Awesome. Well, thank you so much, everyone, for staying an extra few minutes and for all your engaging questions. We will be posting this recording to the website shortly and doing a follow-up. I'll be sending a follow-up email to everyone as well. You can watch for all 4 session recordings to come onto our website later this week. So this session and the 3 previous ones. And of course, you can reach out to any of our strategists at any time at BusinessLink, and we're happy to point you in the right direction and send you to all the right resources as well. And a big thanks to CPA Canada for doing these sessions for us, and Busola for staying extra and taking everyone's questions today. Thank you very much.
Thank you all very much. I've really enjoyed the session.
Take care.